Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. I think it's like 7 p.m. in London. It's 1 p.m. on the East Coast. Guy Adami, Dan Nathan. It's Thursday. That means EY from SoFi will be joining Butters today. Oh, my goodness. Update of a Disney trade. Well done by you. Rangers play tonight. How you doing, Dan?
I'm doing great. We missed you yesterday. It was just Carter and myself.
Yesterday I had to go to the train station. Not that anybody cares.
Trains, planes, and automobiles is
Newark,
really what you
New
did.
Jersey. And it's I hadn't been in a while. It's an interesting place. And I met a lovely guy, Malik Phillips.
Oh, nice.
Yeah.
Fan of the show?
He's familiar with CNBC's Fast Money.
You know what's so crazy? So I was at the Ranger game the other night. A guy comes up to me and he says, "Hey, man, I love your podcast." No shit. Okay. I love your podcast. And I said, "That's great." I was like, do you watch the show? Do you watch?"
I said, "What show?"
He said no.
That's a bit of a sea change.
Yeah.
That's like the world's crossing over, converging.
I've had that happen to me a couple times. And again, I think it speaks to just the way people are consuming content in general, to be very serious. You know what I mean? Like some people just want stuff that is in a format that's digestible and right to their ear.
And they get it in their favorite podcast store. So let's take a look at the rundown so you know what we're talking about. As I mentioned, we're going to be talking about the Disney trade update, Butters and his earnings inside preview. But we're going to start with this head fake rally. Now, people on Twitter are like, you just can't accept it, guy. You can't accept it. The market is kicking your ass. And you know what? Certainly seems to be. The last week and a half or so with that bond move that we've talked about, the subsequent move in the S&P, we're still in this downtrend, I think, in the S&P. Ish. But that's what we're going to talk about. And let's start by, I think it was Ellen Bostic or Ellen, what's her name? The actress, Barkin.
Ellen Barkin.
Yeah. She was making comments.
Were you a fan back in the day?
She was in a movie with Al Pacino.
Yeah.
She's been in a bunch of different movies. She was married to Ron Perlman.
She was.
For a period of time. I think Gabriel Byrne. But all these Fed heads are out there making comments. Bostic, full impact of rate hikes yet to be felt or yet to come. I agree with that, and we've said it now for quite some time. I'm surprised that it's not here yet, but doesn't mean it's – and Elizabeth talks about this. It doesn't mean it's not going to happen. As a matter of fact, one can say the longer it doesn't happen, maybe the worse it becomes. I don't think it just sort of easing into this thing. I think we're going to see it all of a sudden. Like it's going to be very precipitous when it does hit.
Or it's just starting to happen. In the jobs data that we saw, the revisions that we started to have, maybe the jobs market wasn't as strong. And listen, like that actually with, we've had David Rosenberg, he was on the pod on the tape on Friday, and David, interestingly has been saying that the Fed has been way too aggressive for too long. He hasn't seen the economy as strong as many think, right? As many have thought that the unemployment rate or the non-farm payrolls have been suggesting that GDP numbers seem like a big fugazi. So I think we're going to look back and say, wait, the month that the Fed went back and revised lower all of those non-farm payrolls, the month that we just got to our
8 months, by the way,
highest unemployment rate in a very long time, right? The month that we're seeing ISM slow down, for another consecutive quarter, maybe that month was the month where everything kind of caught up to itself.
He might be spot on. I also think, and again, it's hard to predict these things, but I think one of the Fed's biggest fears were not basically doing the same as, replicating the same mistakes of the early 1970s when they declared victory over inflation, only to have it come raging back less than a year or so later, right in their face and in a more fierce way. So I think they're really, we use the analogy of when you blow out the candles and those fun candles that keep lighting up. And I think that's what inflation is. Just when you think you've blown it out and it's done, it comes back again. And I think one of their concerns is, again, not replicating the same mistakes were made 50 or so years ago. So we'll see. I mean, but that's why we talk about this. Let me ask you this.
So we had the 10-year below 4.5 yesterday. Ken Griffin, Citadel founder, making comments about just structurally higher interest rates, higher inflation, that sort of thing. And then if you look at these the Fed comments that we're talking about, it kind of speaks to that. Is that why we've seen a 16, 17 basis point reversal on a 4.5 number, on a 4.5 10-year yield? And so I guess my question is that sooner or later, if we're going to start or continue to see the volatility bands continue to widen, right? Okay. So then, if we're going to see that in yields, doesn't that have to actually be the case in stocks? And we have somebody who's a bit smarter than us.
No, most
who's
people
actually been
smarter than
writing
I am.
about it. She's got a blog. It drops every Thursday on the
Wisco.
SoFi.
She's from Whiskey.
She is from, well, we call it Wisco. Oh, that would be EY from SoFi. There
smile.
she is.
You know, I'd like to be 1/3 as happy as Elizabeth is every day, just one day.
Yeah,
because I'm a miserable son. People tell me that all the time. You're a miserable son of a bitch.
Though. You're not, though.
You know what? I think, not that we won't need to talk about it on this podcast, because Danny and I had this conversation, but I think when you're in touch with the human condition, it's exhausting.
Yeah, well,
it's miserable
with the human condition of joy. Like she is. Look at that.
No,
like,
look,
she's always
I know.
happy.
Yeah.
Always happy.
Well,
how you doing?
One of my favorite quotes: "Laughter is the shortest distance between two people." So I try to laugh a lot.
Wow.
I also
I've
won
never heard
funniest laugh in high school. Those,
is that right?
Whatever those are called. Those, like most likely to succeed,
Most likely,
whatever.
Funniest laugh.
I got funniest laugh.
You were probably voted, if I had a guess, and this is just a guess, most athletic too.
No.
No?
No.
Oh, wow.
I participated in athletics. I captained a couple teams,
So but
that does not mean that I was necessarily the most athletic.
Well,
Ask my dad.
Eve Arden said in Greece, Dan knows this. Elizabeth, you probably appeared in the playing of Greece in your high school. If you can't be an athlete, be an athletic supporter, which is one of the great lines in movie history. Anyway, we're
all right.
Off the rails
So Doug Cass pointing out weak auction, and that's why we've seen this
shocking
kind of bump in yields here. Liz, break this down for us. You heard what we just said. If we're going to start to see this sort of volatility in yields again pick back up, are we likely to see that in the equity market? I think that's actually the crux of a lot of what you were writing about today in your blog.
Yeah, well, I mean, I don't think we ever stopped seeing volatility in yields, and the way that you look at these yield charts moving, it's wild, and it's not something that any of us have been used to. Certainly not in my career. Anybody who's been investing longer than me maybe doesn't remember it since 40 years ago. I mean, this is not natural. And when you look at it from the lens of the biggest bond market in the world, the one that is supposed to be steady Eddie, completely liquid, never really surprise us, it's been surprising us a lot. Now, one of the things that I think about pretty often is, no matter if I agree with the market direction or not, or if it's moving the way that I thought it would, it needs to at least make rational sense, and the relationships need to make rational sense. And we're in a place right now, and we have been, I would argue, since the end of July, where yields and stock prices are moving in opposite directions, which makes rational sense. So as yields rise, stock prices should fall, and vice versa. And we've seen over the last few weeks, we've seen obviously this precipitous drop in yields and a very fierce rally on the other side of that. And the other thing is, when you look at just the behavior of the rally, I think what's happening and what happened last week versus what's happening this week is that we had pretty big surges in breadth. That's breadth with a D. I can't pronounce it any other way than to say breadth. So I got to point out that there's a D in it somewhere. The D is silent, evidently. There was a pretty big surge in breadth last week, which gave the bulls something to hang on to. They got excited and said, oh, look, everything is participating. It's not just concentrated positions that are leading this. And then that turned around this week. So I think it was Monday and Tuesday, breadth actually turned negative. And now we've got this concentrated leadership again. The other thing, and it pains me every time I say this, small caps just cannot get off the floor. They continue in a downtrend. They can't find upside even when the rest of the market is rallying, and that's sending a signal. However, because I don't want to be dogmatic, this is a period, and I put this in the note too, if you want to pull up that table. There's a lot on the table, but I'll summarize it for you. This is a period where if July was the last hike, we're in this purgatory period between the last hike and the first cut, where markets actually tend to hold up pretty well. So it's that third column, last hike to first cut return. Yes, there are some negatives in there, but they're only single-digit negatives, and there are a handful of double-digit positive returns in there. So we're in that period right now if July was the last hike. And I just want to point that out to say the market might be okay throughout this period, but I stand by the thought that the Fed will have to cut sooner than the market thinks.
That's a fascinating. I look at that and I try to go back in time and say, because we were just talking about the early 70s. So that period in May of 74 until the summer of 74, it actually makes sense. You know, I can go back and probably explain away what we saw in December of 2018 into the summer of 2019. I mean, we talk about that period of time from Halloween into Christmas all the time. So a lot of these make sense. This is its own animal now because outside of the early 70s, the inflation problem hasn't really gone away. And I think that's sort of one of the factors that, I understand the numbers speak for themselves, but that's a wild card here in terms of the returns from now until that period where they cut. So it's a fascinating conversation.
Yeah. And the other thing that's interesting is that there's been this conversation recently about, okay, hikes are done. We're celebrating it. I think the market is celebrating prematurely that restriction is done. That's not necessarily the case. Maybe the hikes are done, but the restriction is certainly still here. If you go back and assume that July was the last hike, the market is actually down since then. So that doesn't necessarily fall into that category very cleanly. If you look at when the market stopped pricing in additional hikes, which was about mid-October, sometime from the 17th to 19th of October, the market is up from that point. So this is all cherry picking, right? You can choose your begin date, you can choose your end date, and you're probably going to find the data that proves it. That's what makes these periods so difficult for investors, because it could literally go either way. And there's not a whole lot of messaging in these purgatory times. It's almost like you just got to survive it and wait to find out what's on the other side.
Yeah. The problem, though, going back to the concentration in the market, there's not other places. I mean, other than being invested in the major indices, if you just look under the hood, and we've gone through this again and again and again, there's not too many places to survive it. There's not too many, like cyclical sectors are trading really badly. Defensive sectors are trading really badly. Look at the XBI today, right? So like the list goes on. And so that's a fine table. Okay. But the only thing, and I want to throw out all those other periods, because the guy had just mentioned about inflation. Okay. This is what's different. Okay. We had a guy on our show, without naming any names, and I was screaming about how rates are definitely going lower. You know what I mean? It was okay, what do you know that I don't know? I have no idea. Ken Griffin says they're going higher, Paul Tudor Jones a month ago said we're going to be in a recession. Where do you think rates are going to be there? Maybe they don't go down that much, but maybe they don't go up that much. Maybe we just have stagflation. What's that good for? You tell me, right? So the only thing that that I'd say that I think really matters is the period in which we stopped raising rates in May of 2000. The Fed stopped raising rates in 2006. I think it was also May. You can do the distance between that last rate hike, right, to the first rate cut. But all I know is when they started lowering rates, they went to 1% in 2000, in 2001, and they went to 0 in 2008. And I know that the stock market got cut in half both times. Okay. And I also know that in 2018, when they were raising rates and they got to 2.25 or something like that, and then they stopped, they had that 20% drawdown. So that's all I know. And I think those are the only relevant periods, because those are the periods in which, to Guy's point about monetary policy and all the stimulus that has existed, that's when things got haywire about 23 years ago.
I'd be interested. Maybe I'll do this because you
should do it.
I torture myself.
Yeah.
It's like that guy in Da Vinci Code. Remember when he, with the self-flagellation.
Yeah. Well, that book starts out the very start of that book, if I remember correctly, about one of these crazy priests, who was like a killer priest or something, who was using that thing, around the leg that causes the plague. That's how the book starts, just kind of showing the depravity of one of the main characters, and it's exactly what you're talking about. So you're going to start. Do you wear one of those things? What do they call those things?
As often as possible. Painful. That's what they call it. What I was going to say was, I'll go back. I'll take that chart and go back and actually try to look and see if I can read about some of the rhetoric that was going on at the time, just to sort of figure out what precipitated some of those cuts and then some of those subsequent moves, because it is a healthy exercise. Again, each one of these is different, but there's similarities between them all.
All right, well, let's pull this up. So Goldman Sachs, their economists are out. This, I think, was from the Daily Shot, and they're talking about the potential for the U.S. to be in a recession. I mean, one of the reasons why, my point is that we have a Fed balance sheet at north of 8 trillion. Last time it was 4 trillion. During the final. So my point is there's a lot of sooner or later. I mean, something's got to give here, people. And so I don't know, man.
But it's real quick. And Elizabeth has comments, but we talk about recessions. Are we in one, out one? And I said this a year or so ago on the show. We had one of those glib economists on. And my pushback to him was, does it even matter? I mean, if you think about the food insecurity in this country, like 1 in 6 people or something, 1 in 5 people live paycheck. I mean, the numbers are staggering. The numbers that we talk about are late 20s, early 1930s stuff for a large swath of this population. So to talk about recession is almost insulting for a lot of people. So whether we're in one, going in, I don't necessarily know if it's statistically it matters when we're dealing with what we're dealing with right now.
So Liz, like opine on that, because again, we won't know that we're in a recession. We can start seeing data that suggests that we might be headed towards a recession, right? Like, so how do you think about that? Because this goes back to last year, in October of 2022, the stock market, when the S&P was 3,700 or something, was trading like we were most definitely at least in a, or about to enter one, maybe in one, that sort of thing. And again, we know the stock market is a discounting mechanism or whatever. Well, we never had the recession, and here we are now, well above those levels. We're just below 4,400 here off of the 4,600 52-week high. Like, does what Guy just mentioned about, like, does it matter if we're in a recession? Like, how do you think about that?
I don't want to belabor that table, but if we can bring it back up again, I'm just going to speak to a couple of things. So I do think it matters in the sense of how we're going to chart it, how we're going to look back on it, how we're going to talk about the timing, and how we're going to learn from it, and how we're going to talk about the business cycle. But the last column on this table is really important too. So yes, we're in the purgatory right now where the market tends to hold up okay. But that last column, last hike to market low, first of all, the takeaway here being there was only one time where there wasn't a subsequent market low. The market low actually occurred on the exact same day as the last hike. If July was the last one, that's not how this one is going to shake out. The rest of the times, that 0.0% return is because the low happened about a week and a half later. So there wasn't enough time for anything to really move. But look at the rest of those double-digit drawdowns, and some of them very, very dramatic. So typically there is a subsequent market low. The point that people will bring up is that not all of these market lows were paired with recessions. And that is true. So if we're looking at the timing of it, this is why I think it does matter whether or not we're in one, but it only matters when we are looking in the rearview mirror. It's not necessarily going to matter in the moment. But if we have one, you're going to see numbers more like the last few on that column, right? If we don't have one, you see numbers more like the first few on that column. Now, we already had about a 25% drawdown, and I know I talk about this a lot, but that's why it matters. If we actually are decidedly heading into a recession and we start to get indicators, I'd argue we already have them, but we start to get indicators that confirm that we're decidedly heading into a recession. We just haven't heard from the NBER yet that it counts. That's when the market starts to sell off even more and more ferociously than I think investors would be ready for, because that's what has not happened yet. So far, we've had the bear market, right? The cute bear market that wasn't necessarily recessionary bear market. If we get to that recessionary level and people are pretty sure it's happening, that's when you get recessionary pullbacks.
Let's just take a look at your note real quick, because just the titles alone, look at it, Done and Dusted. Was that like a movie? Or I should know this, I'm sure.
I think it's just a phrase. Maybe it was a movie. It's just a phrase. Done and dusted.
Basically, you're done and I've dusted you off. I've moved. Is that what we're saying here?
I don't know. It's maybe one of our viewers can tell us where that came from. But done and dusted. This isn't me declaring that the Fed is done, but the market has declared that the Fed is done, right? We have no longer priced in any more hikes. We pulled forward the first cut 1 month. So the market has decided that hikes are over. And the rally that has started, really started with a feverish tone after that last Fed meeting, because they paused again. So now people are thinking, all right, that's enough pauses in a row. They're probably not going to go again. And then you've got weak labor data. There's just the relief after having a 3-month pullback. So I think there are a few things that were leaning in the market's favor. Also, not to mention that period between last hike and first cut, where we tend to kind of hold up pretty well. I would almost compare it to, which we're gonna talk about this a lot next year, more so than any of us want to. Markets loving gridlock politically, where you've got half and half, right? And the market tends to go up when there's gridlock because there's nothing new that's disappointing. This is kind of that same scenario, not necessarily gridlock, but this in-between time of we don't know if we're hiking, we don't know if we're cutting. Markets tend to like that kind of stuff. So this idea of being done and dusted, okay. We talked about this last week. I'll say it again. It's the same idea as the inversion of the yield curve. It's not the inversion that gets you, it's the re-steepening. It's not the hikes that gets you, it's the cuts. So as we start to near the period where cuts are more on the horizon, that's where you have to start to get nervous. Now, that could be very far from now. The market currently thinks it's June of next year. I would wager that it's going to be pulled forward a few months more than that, maybe just a couple months, but I think it's going to come closer and closer. So as time continues to pass and as we pull those cuts forward, that window will close, and I think nerves pick up.
Which, by the way, you said a couple weeks ago that exact same thing, and it's proven to be extraordinarily prescient, like many of your comments are, that you thought that timeline would actually be pushed a lot closer than the market realizes. So once again, good on you.
Good on you, Liz. All right, before we let you go, I want to get your take on our main man, John Butters, his note on the Earnings Insight blog that's going to drop tomorrow on the FactSet website. You can also get it to your email box. We'll put the where to do that in the show notes here. But I thought this was really interesting because we're kind of basically down to tag ends of S&P 500 earnings here.
Stems and seeds.
Really? Guy,
somebody said that once.
I know.
It's like Lou
they say
Costello.
seeds and stems. They don't say stems and seeds.
Oh.
Generally, it's seeds and stems.
Okay.
And that really means what is on the bottom of like a
bong.
No, on the bottom of
bowl.
a bag. They call it shake. Okay, so you don't want to smoke that. Okay, so kids, don't do drugs. Stay in school.
Yeah.
All right, we're gonna do this again here. Okay, so every Friday, John Butters, he is a senior earnings insight analyst over there at FactSet. He drops his blog, and we get a preview of it on the Thursday market call here. And I think this one is really interesting as we get to the tag ends of Q3 earnings here. Mr. Butters is talking about how analysts have lowered earnings estimates for S&P 500 earnings companies for Q4 2023, Q1 2024, and Q2 2024 since October 30th. However, earnings growth for the first half of 2024 is still expected to be higher than earnings growth for the second half of 2023. For Q1 2024, 9 of 11 sectors are expected to report earnings growth of for Q2 2024, 10 of 11 sectors are expected to report earnings growth. NVIDIA and the Meta platforms are projected to be 2 of the top 3 contributors to earnings growth for the index for both Q1 and Q2. Now, one of the other things that he had in this report, I thought was really interesting, Liz, is that while Q4 estimates have come down a lot, they haven't seen, and he's updated this a little bit, we still have double-digit expected earnings growth for 2024. So talk to us a little bit about that. Near term, analysts have gotten a little more downbeat about Q4, okay, but they haven't gotten the commensurate level of downbeat for 2024.
Yeah, I think it's more than a little more downbeat for Q4. That was a pretty big move, just out one quarter. And you're correct, 2024 have not come down yet. I do think they will come down. The other thing, and this is nuanced, I think I've mentioned this before, the other thing that I think is going to start happening is it's going to be less about the revenue line. It's going to be more about rewarding companies for cost cutting and being able to meet their numbers because they're being more responsible with spending. The cost cutting, however, we've seen cost cutting already occur, and a lot of these names that might meet expectations, cost cutting in the ad space and other types of spend that happen in tech, but cost cutting in a lot of companies that are cyclicals, and we know that cyclical companies have not been trading well, so it would suggest that they probably have to do more cost cutting. Cost cutting in those types of companies is going to come in the form of things that are a lot more tangible, much like the labor market. So what the labor market is showing so far, including the data today, initial claims, continuing claims, is that hiring has slowed, but layoffs have not gone up. So if people have to do more cost cutting, if companies have to do more cost cutting to meet these expectations in order to not be punished by the market, because we now have seen the market punish misses quite hard, in order to not be punished by the market, they're going to have to cut costs a lot more aggressively. And I don't think that that's going to be met with a very positive tone.
Cutting costs is code for not Elizabeth's code, but we're going to cut jobs. So, I mean, that goes hand in hand with what we've been talking about. And forgetting about stocks for a minute, the fact that they're still considered 2024, earnings growth, it's a pipe dream.
Yeah.
If you listen to what Caterpillar said in terms of their dealer inventory and some of the outcomes that they see next year, Maersk, we've talked about. I mean, the CEO, I'm paraphrasing, but was talking about potentially disastrous 2024 across a swath of industries. You talk about the double, triple ordering, that will have ramifications in 20. I don't know how you're going to see the earnings growth necessary to keep valuations where they are.
Well, the one thing I'll say, if you look at like a very cyclical sector like semiconductors, they're trading pretty well. And some of the guidance that was given was pretty decent. So Global Foundries this week, we had Taiwan Semiconductor talking about stabilization a few weeks ago. We did have, Texas Instrument in the industrial ex-auto space, not particularly great. There were a few bad ones, but I think people took away from Intel, from AMD, from Taiwan Semi, from Global Foundries. Micron's making new 52-week highs today. So that's the one thing. I listen, I want to be very, very aware of the stuff that is trading particularly well. Guy, you mentioned, a bunch of industrials, you mentioned transports, retail trades horribly, healthcare trades horribly. One name, and I know that, the cult followers here are going to have an issue with this. Tesla, the fundamentals are not good.
Downgrade today.
I know, but like it's down 6% on a downgrade from HSBC. No, I think people are finally realizing like this is not going to get better, you know what I mean, anytime soon right now. So to me, I just bring it up there. There's a lot of cross currents. They remain. All right, Liz Young, EY from SoFi. We appreciate all the heavy lifting you did here today. You guys know where to find her. Look at that. SoFi.com/blog. That's where her Thursday blog can be found. And also on the Twitter at Liz Young Strat.
I hear Strat. It's just badass. Like Liz Young Strat.
She's badass. All right, Liz.
By the way, the Bucks.
Yeah. It's Sixers Celtics.
You know what? It's interesting. I'm happy that Craig Counsell, who's a Midwest kid, as you've said, at least he stayed in the Midwest. Okay. He's got, I think, 4 kids.
No,
it's not good.
Reject. No, because the Cubs of all the teams, I mean, anybody else in the division, like why not the White Sox? Go to the White Sox.
Look at you.
That's fine.
That's fine. Well, it's benign. Well, I think he grew up. I think a Cub job for him was like a dream job.
Why not?
So, the Brewers fans are not happy. By the way, your old guy, Josh Bader, I think that's his name, who then got traded by the Brewers. I think he's out west. I think he's in San Diego. He might be a Yankee.
San Diego.
Let me just tell you something.
It's way too early to be talking about baseball here.
Elizabeth, tell him it's never too early to talk about baseball.
Baseball's a year-round sport.
Listen, we have a lot more to go through on the single stock things here. So,
sorry.
Hey, Liz Young, thank you so much for being here.
I'll see myself out
one day.
You'll see yourself out
on the tape podcast. Liz will be with us again. All right, let's talk about some stuff here, Guy. Let's talk about these semis for a second, okay? Because I think this is really, really important, okay? Micron breaking out to a new high. We saw the move that Intel had. We saw the move that AMD had, and good on you. You liked both of those, I believe. SMH now is just powering. We were talking about that massive double top if you pulled it out to a 5-year. Yes, it's still there, but it's coming back. It's still in a bit of a downtrend here. Let's pull up the NASDAQ chart. We have that one. We talked with Carter yesterday. That downtrend that had been in place, it broke out of that. Okay. Microsoft got back to those prior highs. You could have a little bit of a false breakout here. I'm just thinking, can the semis and Microsoft drag up the entire NASDAQ?
Well, that's what's going on. I mean, clearly, Microsoft new all-time high. Apple reverse course off that shitty quarter, traded north of 180. I mean, so yeah, you could definitely have that. This could be a false breakout as well, without question, especially. I'm not saying we're confusing anything, but that move is exactly the same move as the TLT effectively, or the inverse move to the bond market. So if you look at the low over, in mid-October-ish, that coincides with yields at their zenith. And this move higher coincides with yields going back down to 4.5%. So if yields get back on their horse and we can have that conversation, I think this will turn as well. And that chart is something we pointed out for a while. I know for a fact, we thought TLT a couple of weeks ago could trade between 88.5 and 89. I think it got up to 89.5, maybe today.
Yesterday was the
look at the move. I mean, it's down 2 handles today.
Yeah.
On that auction. And that goes back to what Elizabeth was saying about bond volatility. So I don't think any of this is over at all. So
let's pull up the SPX really quickly, because while the NASDAQ or the NASDAQ 100 broke out above that downtrend, the S&P has not gotten there. We were talking about it yesterday. We're talking about basically Apple and Microsoft, that 14.4% of the S&P 500. That's the highest that they've ever been. I think it's the highest concentration of any two stocks have ever. So that's the one that maybe you want to focus on a little bit. I did a trade in the QQQ to start out the week, and I was focused on NVIDIA, okay, and I was focused on Tesla. I got one of them right. I thought that both of them were kind of giving it up a little bit, but the NVIDIA is the one that obviously is dragging up the rest of the industry, the semiconductor industry, and a bunch of the AI stocks. And Tesla is just really, I think, focused on just auto sales being really poor, demand for EVs and the price war going on there. So that one I got wrong. I'm a little early on the QQQ trade, but we'll continue to update that. I want to update another one, Guy. This is Disney yesterday.
Comes out DIS.
Carter laid out a very bullish take on the technicals there. My take was, listen, 6% implied move in either direction. You can pick a direction in the weeklies and basically buy a call or a put. It's going to be 3%, but you have 2 trading days during that. That's not a great way to trade for a directional into what could be a binary sort of thing. We looked at December expiration. Let's talk about, maybe we'll just run the clip of what we had to say yesterday, and then let's update this trade idea today.
Let's talk about the circumstance at hand. A long-term winner, bottom left, upper right, that is sold off 67%. And that 67% sell-off leaves it down to the penny. I think you make the bet.
So I want to look at December expiration, okay? And I want to basically play for a move back to that May gap that was after earnings. So today, when the stock was trading around 84, you could look at the December 85.95 call spread, paying about $2.70 for that, buying one of the December 85 calls at about $3.40, selling one of the December 95 calls at about 70 cents. You have profits up to $7.30 between 87.70 and 95 with a max gain of 7.30 above 95. Losses of up to 270. Okay, so think about that. Losses of up to 270. That's very similar in price, right, to that at the money weekly call, right? But I'm giving myself over a month and the event, okay? So I can lose up to that 270 between 85 and 87.70 with the max loss below 85. So I'm risking about 3% of the stock price with break even up about 4.5%. And I have a max gain of close to 9% in a month if the stock is up 13% between now and December expiration. All right, well, let's look at this thing here now. So the stock has rallied. It's just below $91 as we're talking about this. So this was a December $10 wide call spread, buying the 85, selling the 95. So with the stock here just below 91, that $10 wide that cost about $2.70 when the stock was 84 is now worth about $5.50. So it's about a double. So you have that in a day. And one of the things, I think this is really important to talk about here, okay? So I have until December expiration. If this stock continued to move higher on December 15th on expiration, this call spread can only be worth $10. I paid $2.70 for it, so I can only make $7.30. I think having this move right here, I think you take the money and run. You have a double here and you move on. But I want to go to the chart, Guy, and I want to get your take on this. I want to get a take on what you think you heard from Disney here, because this thing just broke that downtrend, okay, that's been in place from the February highs. You look at that 200-day moving average, that might be a little resistance. We were targeting 95, which was kind of that, there's going to be some resistance there. So thoughts here. You had the trade, you got it right, you move on, okay? But let's get your take
a couple
on this
things.
thing.
So number one, yes, you can check change, say great trade in less than 24 hours, well done. You could also say, you know what? I'm going to take half of this off, which means if I take 50% off, I'm in the rest for free. If you think about it that way, you could take 2/3. You can do any permutation of that, understanding that your max gain is exactly that, $10. Number one. What I've said last quarter incorrectly was it felt as if that might be the quarter we come back to. And for a period of time, it looked correct because the stock bounced, gave it all back. I said last night on Fast Money. However, something has changed. If you look at this chart, you have a series of lower highs and lower lows until you get to early October, where we traded down about 79 or so. We bounced. And this recent low was actually the same low. So you have this little bit of a double bottom. I said last night, there's a chance, given this quarter, $98 is not a pipe dream. And if you look at some of the gaps that we made to the downside in the middle of this chart, it makes a little bit of sense. So again, do you have to go run out and buy Disney here? No. But if you're asking me to answer your question, yeah, you can take off half, be in the rest of it for free. You could let it ride. You can do any number of things. But I still think there's going to be a lot of people potentially playing a little bit of catch up here in Disney, thinking, you know what? The cost cutting, now $7.5 billion. The free cash flow number was much better than the street was looking for. They talked about potentially reinstating a dividend, like all things you probably wanted to hear from Disney. You heard yesterday on that call.
Yeah, the other thing is about the trade management too. So again, you could take the profit, you can sell a portion, you let the profit. You could also roll up and out too, right? So you could basically say, I'm going to take the profit here and I'm going to dedicate some of that to, let's say, buying the January 95 calls or something like that. It seems like it's kind of far out of the money, but again, you're taking a portion of the profit. And if this stock really does get going, and sometimes you have that kind of New Year effect, dogs of the Dow sort of thing or whatever. So that's the way that I would probably trade this from here, but you got optionality, pun intended there, people. All right, Guy, let's talk about Eli Lilly, because this is one that has been part of this mega trend, these GLP-1 weight loss drugs here. Obviously, Lilly has a couple drugs. One was for pre-diabetes, but the other one has just been approved for obesity. And this is the one that a lot of folks think is going to be a massive unlock. You start getting these supplies coming. You know, there's a lot of competition here. There's going to be competition from oral pills and the like here. But again, this has been between this and Novo Nordisk, which makes Wegovy. These stocks are more than $1 trillion in market cap, and they both look like this. So it's interesting, Guy, that today, so yesterday, the FDA does this approval. The stock's down 3.5%. So is this a bit of a sell the news? And do you want to keep a very, very close eye on that uptrend?
What we've said about Eli Lilly now for years is every pullback, and you've had significant pullbacks in the stock. I mean, you can look at this chart and say, wow, we've had some 15, 20% pullback seemingly out of nowhere, yet we remain in this uptrend, which is still intact, even with today's move. But I'll answer your question again. Yes, you keep a tight leash on this. I think if you're a long-term investor, don't get spooked by these moves, because I do think Eli Lilly sits in a pole position. We had an analyst on last night, and my question to him was, clearly you can't just sort of look at Eli Lilly through the lens of PEs and revenue. You have to say there is X total addressable market in these drugs out to 2027. What could they garner? And then start doing the math on the back of that. And when you start doing that equation, what looks expensive through this lens is not as expensive. And I think it's just a matter of time. And not that it matters, I want to be clear, but psychologically it does. You know, if Eli Lilly spends a couple weeks above 600, they're going to split 5 for 1, and they're going to change up things a little bit. And that will get people excited as well. So I understand what's going on here. It's sort of a sell the news type of thing. You've seen it 100 different times over the years. I think that's what we're in the midst of now, but I don't think the story is broken at all.
All right, last thing before we get out of here, and I don't know why I'm kind of fixated on this. Let's pull up a 1-year chart of General Motors. Comes out.
GM.
Yeah.
It should just come out, period.
Yeah.
Because it's awful.
I see what you did there. All right.
No, it's interesting. Before we even, there's a school of thought that, we saved the automakers back in the day.
Yeah.
Okay, I get it. I mean, America automakers,
they made money on it. Just, taxpayers.
Fine. It's all good. Yeah. But should they have? I mean, if you think about how shitty these things have been, I mean, and this is
you
just
going to go back to like
hypothetical.
riding your horse?
No. I mean,
do?
I think from the ashes of those companies, maybe better companies would have emerged.
Yeah.
I mean, you can always, it's hard to do the counterfactual. I totally get it. But just through the lens of the stock market, these stocks have sucked.
Yeah.
I mean, Ford's the same price as it was 30-something years ago.
Disaster. Let's pull up the 1 year again, though. So one of the things that I thought was interesting, Guy, the stocks were, both Ford and GM were careening lower, meaning making new 52-week lows into the strikes, and they got resolved, and they've appeared not to be as bad as like the worst case scenarios, right? And you had that pop, but now GM is about to make a new 52-week low, and let's pull it out to a 5-year. So I wonder, what is this saying about industrials? What is it saying about broadening out to transports? I mean, when you look at this chart, I mean, there's no support, and so obviously there's valuation support. But if you tell me, and let's go to Ford for a second, okay, look at it on the same basis if you want, if you tell me that these stocks trade this way after the dislocation that they saw as it relates to demand and the like with the pandemic, you know what I mean, the seesaw action there, and we haven't even had a recession. And I don't care if we're in a recession right now or we get one in the second half of next year. Sooner or later, this is going to be a disaster. And the last one, we'll just pull it up again, and you can do a 5-year if you want on Tesla. Tesla, and there was an article, I think, on thestreet.com, which still does exist. I did see it out there. It was talking about how, one of the proclamations that Elon was making or has been making, let's make that a 2-year chart if you don't mind, is that, Tesla cars don't depreciate. They hold up much better, okay, than a lot of US cars. Well, they've been cutting prices, and without naming names, a friend of mine bought a Model Y for 67 grand. Okay, this is about a year ago, or a year and change ago, okay? And that same car is $30,000 less. He felt like he literally got
Top
you know
ticket.
what. No, but on what planet is there a consumer product that you can go out a year and a half ago and pay a certain price for something substantial? Okay, like this is one of the biggest, other than a house or you know what I mean, this
CD player
that could be down 40 some percent or something like that. You know what I mean? So will this person ever buy a product from this company ever again?
Well, I have no idea. Not knowing that person, who he or she
actually
is.
know him.
Oh, well,
I'm not going to name names.
we're not going to dox him.
Oh, look what you did there.
It's interesting. I don't think it's coincidental. And if you put that GM chart up real quick, the bounce north of 30 coincided with interest rates going down. The problem here is people they don't just walk into their General Motors dealership on the corner and hand over $65,000. They finance these vehicles.
Correct.
And if you think about, we had a whole conversation about where are we in the labor cycle? Where is the consumer? I mean, if rates are higher, it just makes it that much more difficult to buy these cars. Don't think for a second that higher interest rates are not affecting all of these stocks. We don't talk about it, but you can look at it and see. You can overlay yield the bond chart with some of these stocks, and it starts to really make a lot of sense. And Elon Musk mentioned it in his last call.
He wouldn't shut up about it. And listen, he's talking less about the fundamentals and more about the macro, and he seems a bit worried there. So
he should be.
Well, I know, but but
these are high end. I mean, I understand that they're trying to go down the food chain, right? They're trying to make cheaper cars. I understand that. But at the end of the day, I mean, the margins are in the higher, right? The higher price vehicles. So you want to give up margins to sell cheaper? I mean,
the margin for this,
tell me.
No, but the margin for these cars is going to be full self-driving. That's the promise of this thing. So if you think that people
I mean,
but 12, 13 grand on this software that lets them have an autonomous vehicle, that's where they're going to make all their margin. Okay. All right.
Look.
All right. Well, listen.
I mean, what do you think's going to go on in these seriously?
A lot of weird shit.
Yeah.
Well,
that'll be no problem.
Should we?
And it'll be nothing.
That?
No, but it's
we had
just the whole thing. Like
we had weird shit going on autonomous vehicles. I mean, this new world that you kids.
I mean, people. You understand how I'm the person that used to, when I was 18, I used to say, "What an asshole!" I am that person
now.
You
are that asshole. The
old it's man like raging against the machine.
Cloud.
It's like
really quickly pull up the Tesla chart for a second of 1 year, and
it's not good.
No, that $200 level when it goes back through there, watch out below. It's
2670, I think, was a recent low in GM. By the way,
listen, we had we laughed, we cried. Here's something really important. We have a super fan, a guy named Jay Sloan, who's been listening to our stuff, watching our stuff for a very long time. He hit Amanda
that's Amanda Diaz,
on an individual story. He's raising some money. He's doing a match. It's for child cancer. It's Pinky Swear. The link is in the description to donate. We're going to also donate Risk Reversal Media. We appreciate Jay trying to do this, raise money for kids who are being really just, adversely affected by a horrible disease. So we appreciate what you're doing there, Jay Sloan. So thank you. And Risk Reversal Media, we will be giving to that.
Jay's a good man. Thank you for bringing this to our attention earlier in the week. And obviously, hopefully this helps get the word out. We'll put it on our individual social media platform, the Twitter.
So go do that if you guys are so inclined. Also, Guy and I, we are on what do you call it? The gram that you're on the Instagram.
Yeah. I don't know what the hell
so
I'm doing.
We're putting out content.
No, because I get these things like these little heart thing with like a number next to it. Like I'm hitting buttons that I shouldn't
talk to
hit.
our team. We'll try to figure it out.
It
all right. So Guy.Adami, follow him there.
Who's it doing?
Check out our stories. That's Mark Zuckerberg. We also have Risk Reversal Media page. So check that out. I am Dan S. Nathan. All right, people. That's it. We're going to be back. Wait, tomorrow's Friday. So we're not going to be back tomorrow. But we do have an On the Tape podcast. This one's going to be hot, people. Okay, so we have Danny Moses, obviously, and we're going to talk about everything that happened this week. We have Halima Cross.
Best.
She is the best. She's from RBC
She's
Capital.
The axe.
She's
she
the axe
is the
in
axe.
the oil patch. Okay, and we also a conversation that you and I really enjoyed, and this is dropping on the weekend of Veterans Day, okay, is Art Dela Cruz. He is the CEO of Team Rubicon, which is an amazing organization founded by our friend Jake Wood, former Marine sniper. They train vets, they deploy them to disaster areas, and we get to hear all about the mission of Team Rubicon. So check that out on a very, very important weekend for the vets. My dad is a vet, retired lieutenant colonel in the Army. So we thank all of them for their service, and we hope they're appreciated every day, but specifically on Veterans Day.
The 11th hour of the 11th day of the 11th month, in case you forget. It's an easy one, should be an easy one to remember. Of course, it's this Saturday, but a lot of people will be not celebrating.
I think Art Dela Cruz is going to be on Fast Money tomorrow.
Oh,
also.
really?
Yes. So he was on our
Danny Moses is
pod.
going to be on Fast Money tonight.
Check it out.
If you've never seen Fast Money before,
this is the night.
This is the night.
Get all up in there. All right. Thanks for being here, everybody.
Later, peeps.
See ya. Bye.